Welcome to Smart Wealth with Joshua, and Merry Christmas to you.
Your daily stock analysis and catalysts talk. Today we're looking at Trump Media.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. There's a really fascinating story here with Trump Media. It's almost a tale of two different companies.
A paradox, really, because on one hand, you look at the core business, the social media side.
Right. And it looks, well, stagnant. We're seeing Q3 2025 ad revenue from Truth Social, and it's actually less than $1 million.
Less than $1 million. And that's a slight decline year over year, too. That's a huge operational problem for a company of this scale.
It is. It absolutely is. But, that is only half the picture. The other half is, frankly, massive.
You're talking about the financial strength.
I'm talking about the balance sheet.
Yeah.
As of Q3, they're reporting $3.1 billion in financial assets. That's cash, short-term investments, digital assets, the works. And that's more than a tenfold increase since the IPO. It's just a staggering amount of liquidity.
Okay, let's unpack this because those two numbers just don't seem to belong to the same company. If your main business is pulling in less than $1 million, where on earth does $3.1 billion come from?
Well, that's the key. It's not coming from the main business. It's almost entirely from non-operating income streams.
So investments.
Powerful ones. In Q3 alone, we're talking $15.3 million just from Bitcoin option premiums.
$15 million.
And another $13.4 million purely from interest income on their holdings. So far this year, those non-operational flows are over $61 million.
So that non-core income is basically the engine keeping the whole thing afloat and then some?
It's the bedrock. It's what allows for everything else we're about to talk about.
But hang on, there's still something that doesn't quite add up. My notes show a net loss for the quarter of $54.8 million. How can a company be holding billions and generating millions in interest, but still be reporting a loss that big?
That is probably the most critical distinction to make here. You have to look at the composition of that loss.
Okay.
Yes, operating expenses were high, around $58.6 million, but the vast majority of that reported net loss, so $54.1 million of it, was non-cash.
Non-cash. Okay, explain that. Give us an analogy. What does that mean in this context?
Sure. Think of it like this. You own a house, and on paper, its market value drops this quarter. You haven't sold it, no money has left your bank account.
Right.
In fact, you just got a big check for renting out the garage.
Right.
That paper loss on the house is what's driving the headline number here. In this case, it's mostly fair value swings on their digital assets. But actual cash wasn't spent.
The cash position is still strong.
Stronger than strong. In fact, Q3 was their second straight quarter of positive operating cash flow. They actually generated $10.1 million in cash. They aren't burning it.
That completely flips the narrative. So they've got this $3 billion war chest that is actually growing. Which brings us to the big question. What are they doing with it?
They're funding a total transformation. I mean, yes, some of it is going into smaller growth projects like their prediction markets, Truth Predict.
And the Truth fintech stuff.
Exactly. But the main event, the overwhelming strategic goal, is the $6 billion merger with TE Technologies. This is a radical pivot into clean energy.
And this is where the story goes from unusual to, well, almost unprecedented. You're talking about a social media company trying to become a first mover in utility-scale fusion energy.
That's the plan. TE has been working for 25 years on its own proprietary reactor tech. The whole pitch is that their design is smaller, cheaper, and closer to being commercially viable than competitors.
And their timeline is aggressive.
Incredibly aggressive. They are aiming for utility-scale fusion plants to start coming online as early as 2026.
Let's just pause on that. 2026. For anyone who follows the space, fusion energy has been 5 years away for the last 50 years. So how does this company convince the market it can pull this off faster than, say, huge energy giants or government labs? Isn't the execution risk just enormous?
Oh, the execution risk is huge, and that skepticism is completely healthy. But the deal seems structured to minimize the financial risk to the parent company. If it works, if they even get close to that 2026 timeline, the first mover advantage would be everything.
It would completely insulate them from any weakness in the social media business.
It would make the social media business a footnote. And what's fascinating is how this move creates a competitive moat.
Beyond just the reactor technology.
Yeah, you have this network effect. The company already has this very strong America First brand affiliation, and user loyalty. That's a moat that protects the social media and fintech arms from, an X or a Meta.
A specific dedicated user base that isn't going anywhere.
Exactly. And that base connects directly back to their digital asset strategy.
Right, the CRO partnership. They're holding, what is it, almost 700 million tokens?
684.4 million CRO tokens, to be exact. It makes them the largest publicly traded CRO treasury out there. And this isn't just a passive investment.
No, it's an active strategy.
It ties directly into their fintech plans. Things like CRO rewards on Truth Social and Truth Plus SEA. The $3 billion war chest isn't just sitting in a bank account. It's an active strategic weapon.
So how is that weapon being deployed to fuel this TAE pivot?
The cash infusion is what makes the deal possible.
Yeah.
The $3.1 billion allows them to inject up to $300 million directly into the merger.
Okay.
$200 million was committed right at the signing. And the final $100 million is tied to a specific regulatory milestone.
The S4 filing.
The S4 filing. Without that cash on the balance sheet already, this whole thing would depend on outside financing, which adds a ton of risk. Here, the money is already in the building.
So let's talk about the market reaction. Because when this news dropped, things changed fast.
They changed immediately. The stock surged 42% on the announcement.
42%. That's not just a little bump. That's the market completely re-rating the company's entire future.
It's a signal that investors see this as a legitimate company-defining catalyst. And technically, it's fascinating. The stock is now trading around 2 times its price-to-book value.
Which basically means the market values the company at double its tangible assets, mostly because of that huge cash pile.
Right. And what's interesting is what came before this surge. The stock was down 70% year-to-date.
So how should we interpret that? Was the stock just oversold?
The argument is that the 70% drop had fully priced in all the weakness of the core social media business. The Fusion merger news basically drew a line in the sand and created a new floor.
And the technical indicators are pointing up now?
They're very constructive. We could be setting up for a golden cross, where the short-term moving average crosses above the long-term 200-day average.
And for anyone listening who doesn't live in the charts, why is a golden cross significant?
It's a powerful psychological signal. It suggests that the recent buying pressure is finally starting to overwhelm the long-term selling pressure that caused that huge drop. The MACD indicator also turned positive right after the TAE news.
So the charts are basically confirming the narrative has shifted.
Exactly. It shifted from a struggling social media company to a high-growth, speculative, clean energy play. And critically, you have very high insider ownership, sitting at 53%.
Which signals a lot of conviction from the people who know the company best. They're betting their own fortunes on this pivot.
It's a very strong signal.
Okay, we've built a pretty compelling case for the upside here. But for this to be a balanced look, we have to talk about the risks. Even with billions in the bank, what could derail this whole strategy?
The risks are very real, and they're all about implementation and regulation. The number one risk is regulatory scrutiny.
Not a surprise.
No. A $6 billion deal this high profile, plus the complexity of the Crypto.com partnership, it's bound to face intense scrutiny. That could easily delay the merger close well into mid-2026.
Which creates a long period of uncertainty for the stock.
A long, painful period of limbo. And that leads to risk number 2, the ongoing drag from the core business.
It's still not making money.
Right. The loss is mostly non-cash, but you still have less than $1 million in revenue against almost $60 million in operating expenses. That operational burn is real, and until Fusion or FinTech starts generating revenue, it's a constant headwind.
So the assets make the risks manageable, but they're still there. So let's turn to the catalyst calendar. What are the specific events we need to be watching for?
3 things in the near term. First, and most important, is the S4 filing for the TIE deal. That's the big one. It's the regulatory document that unlocks that last $100 million in funding.
And financial
Q4 2025 earnings. They're expected in early February 2026. Given their income streams from crypto and interest, a cash flow beat is very possible, which would reinforce the fortress balance sheet narrative.
Okay, and for the big one, the Fusion timeline.
We need to see concrete progress. We'll be watching for any updates on the siting of that first 2026 Fusion plant. That's the event that turns a speculative promise into tangible reality.
And if we zoom out, the macro environment seems pretty favorable for this kind of pivot, doesn't it?
It's almost perfect. You have this insatiable demand for energy, driven largely by AI and data centers. Fusion is one of the holy grails for zero-carbon power. The market is already rotating into clean tech, and if interest rates hold steady, it makes the financing for a big scale-up much easier.
They're skating to where the puck is going, so to speak.
That's the bet. So to kind of synthesize it all for you, the core thesis is this. It's a high upside, speculative pivot. It's not about the current business. It's about that robust $3.1 billion asset base, enabling a transformation into a potential first mover in utility-scale clean energy.
And what's the time horizon here? This isn't a quick turnaround play.
No, you're looking at a fork in the road. Path one is a tactical swing trade. You play the catalysts over the next 1 to 3 months, the S4 filing, the Q4 earnings.
And path two.
Path two is the long-term strategic bet. That's the multi-year hold, banking on actual fusion revenue. That's a 2031-plus horizon. It's a trade on regulatory wins versus a bet on scientific destiny.
That's a great way to frame it. And, looking even further out at that destiny, we have to come back to that massive CRO treasury, those 684 million tokens. By becoming the biggest public holder of a major digital asset, this company has quietly built an infrastructure that could fundamentally reshape fintech. If their ideas for TruthFi ETFs or deep crypto integrations actually happen, their unique position could change how these assets are traded on public markets.
It's a huge strategic advantage.
Right. Backed by billions in assets, it makes this more than just a media or energy story. It's really a stealth play on the future of integrated finance.
It's a story of leveraging unique assets for radical ambition. Absolutely.
If you want more analysis like this on the stocks and strategies defining tomorrow's markets, make sure you hit that subscribe button. Thank you for tuning in.